Hello, everybody, and welcome to the Trading with Ashley show. This is going to be a jam-packed video. I think you're going to love it. It's going to show you a way to use the wheel strategy to generate daily income on some very safe and consistent ETFs, the SPY and the QQQ. But before we jump into all of that, I have a gift for you, and I need you to do me a favor. So I will share with you what I'd love for you to do for me. If you will please check to ensure you're subscribed to this channel. If not, if you will press that subscribe button, that will help me out a lot. I'm really trying to get to a key level on my subscribers, and I think you might be just the one to get me there. Now, what I am going to do for you, there are so many of you that are interested in retiring and trading the wheel strategy. So I have dedicated Sunday, this upcoming Sunday, for those of you interested, I am offering you a free webinar where I will be live with you and I will show you the basics of what you will need to trade the wheel strategy in retirement. I'm going to show you basically how it works, and I'm going to help you figure out if this is something you can actually do or prepare to do in the coming year. Now, if you're interested in this particular webinar, you want to sign up sooner rather than later. It is a very popular webinar, and last time we were unable to accommodate everybody that wanted to be in it. And there's no recording for it, so you want to make sure if you're interested, you got to be there. Sign up below in the link. It's going to be the first link in the description, and then we will have you sent an email with the link to actually join me on Sunday, late afternoon or evening, depending on where you are. Now let's talk about the subject of today, and that is going to be how to do daily trades on the SPY and QQQ. And the reason this is important right now for all of my members, and it may be for you, with the recent volatility in the market, several of my members, myself included, have cashed up. So we don't have as much cash in the market right now, and we're sitting on a lot of cash to the side. And it allows, when you have a nice little pile of cash just sitting there, it allows you to do trades like I'm going to show you today. And that helps you create income on a daily basis. Now, the best part about trading this way is you can wake up in the morning and it doesn't matter if the stock market is up or down, because you are just going to do a trade for that day, and you are going to just take what the market gives you and adjust accordingly. So I'll show you exactly what I'm talking about. I'm actually going to take you through and show you how to figure out what potential strike price you might want to use if the market's down, what potential strike price you might want to use if the market's up. One thing I will show those of you that are interested in this is how to utilize margin to significantly increase your buying power, or the power to sell puts, or if you're put the shares, then what you can turn around and do with those shares to generate regular income. Now, for those of you that don't have margin, that's okay too. We're dealing with ETFs that are not leveraged, so this is a safer way to trade. And if you don't have enough for 100 shares, you can still set buy orders for 2 or 3 shares. That's all it takes to get into this game. And then you can swing trade those shares depending on what the market's going to do the next day. So right now, all of the premium that we're receiving, it's really high because the market's volatile. So we're taking full advantage of that. But once everything normalizes, you won't get quite as much premium as you're going to see me trade with today. But one thing that will happen, it'll get a little bit more predictable, which by the time it gets more predictable, maybe you're more comfortable doing this and you can increase the amount that you're trading with. All right, let's go into the computer. I'm going to show you everything I'm talking about. First, let's discuss why this strategy may be considered safer than doing a poor man's covered call against a leaps. When you are using a leaps and you have sold a shorter dated covered call against it, you do have to worry about the potential assignment dynamic. If you don't actually have the shares to back up the call and instead you have the leaps, then you have to worry about your leaps being shut down. Now that could be costly if your leaps is not yet in profit, or if you haven't gotten over the threshold of the fact that you paid for that leaps. When you're dealing with the shares alone and you have the cash or margin to back up the sold put, then you're not afraid of assignment. In fact, you welcome assignment because in this situation, you will make more money after assigned the next time the SPY or the QQQ rises. Well, if you already have the SPY or QQQ due to being assigned the shares, then when it comes time to sell covered calls, you actually want the call away. Also, this is a more passive way of playing the daily SPY and QQQ. For instance, if you have something to do in the afternoon and you have a sold call on your shares, you're not so panicked or worried about it breaching your strike price. In fact, if it's called away, that's actually a better opportunity for you because now you have created more cash to work with on the next red day. Next, we need to figure out how to determine what strike price we might be interested in. So what I did was I looked at the history of the SPY and the QQQ movement, both daily and weekly, so you can adjust this based on your preference. But if you want to accomplish actually just accepting premium 90% of the time, then looking at the SPY daily movement, you can calculate a 2% move and you should win that trade about 90% of the time. If you're looking at a weekly SPY dynamic, you could expect maybe a 4.5% movement up or down. Now, the QQQ, it's a little bit more volatile and you'll be paid for that volatility. You actually can make more premium on the QQQ. A daily move of 2.5% is reasonable, and if you use that figure, your trade would win about 90% of the time. Looking at the weekly QQQ trade, you can calculate about a 5.5% move up or down each week. Now, all this does depend on volatility. If volatility is 20 or lower, you can expect that this is a pretty reasonable way to assess your strike price. But if we're above 20 on the VIX, then you may want to give yourself a little bit more wiggle room for your sold put and your sold call. Maybe for the SPY, bump that up to 2.5%. For the QQQ, look at about a 3% figure. And if you're looking at weekly, for the SPY, you might consider 5% weekly. And for the QQQ, you may calculate 6% weekly. Also, if there's something that is going to potentially move the markets during the day, such as the Fed speaker, you may want to wait until after that event to determine what direction you want to trade in. Now for the calculation, let's go look at where the QQQ ended today, and that was right at about 454.56. If I wanted to calculate a potential move for tomorrow, if I am seeing that the market is going to be trending down, then I might consider looking at a 2.5% move down. To do that, here is how you would calculate it. You would take the 454.56 and multiply it by 0.975. The result would be 443, which would be a 2.5% down movement of the QQQ. If it appears that we're going to have an uptrending market, then you would do something a little bit different. You would take the price of 454.56 and then you would multiply it by 1.025. That would be 465.92. So your potential range for the day would be either between 443 for puts or 465 for the call away of shares that you already have. Now, I personally usually like to wait between the first 15 and 45 minutes to actually place my first trade. I like to see how volatile the day is going to be, and I like to also see how the range develops throughout the morning. Once I've selected up or down, then I go ahead and I look at potential strike prices. Let's go do that now. If I am looking to sell puts daily, so this would be tomorrow that I would be setting this up, I would look at the 443 strike, and right now it is paying 92 cents a share. Looking at the call side, 465, you are looking at 60 cents a share. So for one contract, that would be a $60 trade. Now, I would not want you to be afraid of the call away because that's where you would make significant money. Let's take, for example, if we had been put the shares at 454 and they were called away that day at 465, that's an $11 per share gain. And this is in addition to selling the call on your shares. So in that scenario, that would be $11.60 a share, which would be $1,160 for the call away in one day with one contract. Now that you have a better understanding of how to select your strike prices, let's go in and look at how margin can help you in this situation and how much cash it might take if you're interested in doing this. Now, regarding margin, you should only use it if you understand how it works and you're comfortable doing so. Otherwise, this strategy can just be used with cash. Now, I have 10 contracts that I sold on the QQQ. Now, these ended up expiring worthless, so I was able to keep all of the money that was produced that day. But it took far less than $44,000 for each trade, and I'm going to show you why. Now you can see here, instead of requiring the over 400,000 for this trade in cash, it only required 102,000 of my available cash to use the trade, and the rest was pulled from margin. And so you want to be careful when you're doing this. I reside myself to the fact that I never want to use more than 30% of my available margin so that I will avoid that dreaded margin call. Now, if I were put these shares, then it would reduce my margin power by quite a bit as well, but I could turn around and sell at the money or slightly above the money calls to have the call away happen the very next day. Now let me show you a few examples. One I actually opened up this morning and it looks like it's going to expire worthless. You can see right here I sold 10 puts on the QQQ at the $4.58 strike price. For that, I received $1,000 in premium, and this will expire worthless today, and I will get to keep all that premium, and then all the capital and or margin being held will be released to me to trade with tomorrow. Now, for those of you that don't have the kind of capital to be selling that many contracts, let's look at a few swing trades. Well, here you can see on April the 22nd and April the 23rd, which was just a few days ago, I actually made a purchase of the QQQ when I saw it pulling back. Well, here we sit just a few days later, and all of those shares right now have profited $3,164. Now, one thing I did do is I went ahead and I sold a call today to take these shares away if the QQQ ends at the 465 mark. So if it goes higher than that and it ends a little bit higher, then I'll leave a little bit of money on the table. If it doesn't call them away, then I'll just simply sell calls at the next available opportunity. Now, it's important to think about risk when you're doing trades like this. Now, there's inherently less risk when you're dealing with a blended ETF like the SPY or the QQQ because you're dealing with several hundred companies. The QQQ has 100 companies and the SPY has 500 companies. So that helps insulate you a bit, but it won't insulate you if you're put the shares and we have a black swan event or a longer term downtrend that won't allow you to get out of the position. If that were to happen, you would have to decide at that point, do you just cut your losses and go ahead and sell at a loss to free up some cash and then repurchase the shares later or sell puts later, or do you just hold for recovery? So I wouldn't put all of my money behind a strategy like this. But if you're looking for daily income in a more safe and consistent manner than dealing with individual companies, this may fit the bill. Now, this type of trading is perfect for potential retirees because once you're retired, if you're going to trade full time, you will have a lot more time to perfect this strategy and get really comfortable with it. There really is no substitute to actually having money in the market so that you can better understand how these options work and how these particular ETFs perform on a day-to-day basis. If this type of trading interests you, be sure to sign up for my webinar on Sunday so that I can give you more details so that you can actually be profitable doing this and have a lot more confidence going into it. Now, for those of you that are interested in a similar strategy, but it has to do with purchasing leaps and then selling a call against it, we call that the poor man's covered call. Well, I have a complete video illustrating exactly how that's done. You can watch that video right here. Remember, if you're with me, trading with Ashley, there is no trader left behind.